go ahead and get started. So I would like to welcome everyone to the Commercial Multifamily Masterminds. We are an affiliate. No, we are a member of the GOB. Boy, where did I get that one from? We are a member of the GOB. So today's host, well, I'm the host of Commercial Multifamily Masterminds. I'm Darryl Murphy Sr. My co-host, Alicia Miller, she can't be here today. She's traveling to Houston, Texas. So while she may jump on while she's in the car with her family. All right. So the GOB mission. What is the mission of the GOB? It is. I like to put it in simpler terms, although it does say the GOB seeks to democratize commercial real estate via mentoring and deal making. Let me tell you like this: the GOB network. Our mission is to provide you with education, network, and support, and an opportunity. That's what the GOB mission is about. I'm asking someone to please mute themselves. Okay, that's what the GOB is about. We're here to help you to get your investment if you need help across that finish line. Now, what's the mastermind mission? Well, the mastermind mission is, hold on one second. So the mastermind mission, hold on one second there. I'm in a just letting her know I don't need room service. Right? So the mastermind mission. Our mission here, one, is to get rid of that competitive mindset. Okay. It is here where we work together, right? And by us being members of the GOB, we work together to provide you with education, to provide you with network, to provide you with support. It is here where we do everything to try to assist you to get your investments across the finish line. But our primary focus is underwriting. That is our primary focus here, underwriting. So the mastermind principle, the coordination of knowledge and effort of two or more people who work toward a definite purpose in the spirit of harmony. Now, if you know anything about Napoleon Hill, Think and Grow Rich, then you know exactly where the mastermind principle comes from. Now, T.D. Jakes said in his book, Disruptive Thinking, a team is composed of like-minded people with different skill set, but equal commitment towards a measurable outcome. So here we do have people with different skill sets, people that we work with and to come together, okay, to help you with your deal and to get it across the finish line, okay? All right, so give me 1 second. Okay. So at this time, I'm not going to take too much time, but at this time, I am going to let our partners introduce themselves and tell you a little bit about themselves. Okay. Okay. Just a little bit now, just a little bit, not too long. Okay. Give me 1 second here. I got to get back to my screen. First, I'm going to, Mark Gross, please introduce yourself and tell everybody what you do.
Sure. Thank you very much, Darryl. Appreciate it. Good morning, everybody. I'm Mark Gross from CSSI. We're the largest cost segregation provider in the country. If you're not familiar with cost seg, what we basically do is accelerate depreciation projects, which will reduce or eliminate your federal tax liability. Works great for syndicators and also limited partners. I'll put my information in the chat for free preliminary analysis for any property nationwide. Thanks, Darryl.
All right. Now, I have to apologize because before I get into the family members, I always have to have the founder, the creator of the GOB. He always got to speak, right? And he's here today. So, and usually I play a recording, right? But today we have the man himself, Jim Biggs. Jim, you want to say something instead of that recording?
Good morning, everyone. I apologize. I'm going to be off mic and off camera most of the time. I recovering from a minor surgery recently, but just very pleased to see everyone here this morning, and just want to reemphasize, Darryl's mission and the mission of the GOB network, the idea of collaborating together, masterminds that you can join. They're all over the place. And usually to get in a room with people like this, you've got to spend a lot of money. And so I just want to, that's okay. I just want to encourage everyone to support the channel, support the JOB network. If you're getting value from this stuff that we're putting out and that we're spending a lot of time and effort and our own money bringing to you, and bringing constantly through the cooperation of some great guests, bringing you content. So encourage you to pass the word around, make sure and like posts that you see on social media, comment if you enjoyed the guest, and let's see what we can do to make this group even bigger.
All right, thank you very much. Now, Robert, please explain what you do and let everybody know how they get in contact with you.
Yes. Good morning, everyone. Thanks for allowing me to speak. Robert, we're going to hear from New Jersey marketplace. Garden State Funding was started probably about 20 years ago, offering asset-based lending for small business owners. I still do that today, just picking up where the banks leave off with working capital and lines of credit, things like that for business owners. That kind of merged into real estate lending for investors from all types of asset types across the commercial types of buildings, and your unique type self-storage facilities, medical, retail, and does your normal apartment building. So I put together either 1-year bridge loans or long 30-year fixed rate type mortgages to acquire or even refinance cash out. So with that said, I started a business unsecured, no collateral types of lines of credit, term loans, and even personal loans up to about $400,000 for business owners that way. So I'll put my info in the chat if you guys need term sheets, LOIs on your deals. Please reach out. Thanks a lot for allowing me to speak.
All right, thank you. Sounds good. All right, so today is going to be different because normally we'll have a guest here. They'll be talking, and we go back and forth, right? No, it's a Q&A thing, a little like a podcast type thing, and we talk about underwriting, right? We show the T12, we show the rent roll, we show the model, whatever model we're using to underwrite. We show that too, right? And we go through the process and we discuss this thing. We interview different guests that come on. But where did the underwrite come from? Where did the things that we look for, such as vacancy rate? We know not to go below a certain point. We know that at a certain point during our underwrite, we have to send it off to the lender, let the lender. Now, if you're not sending your underwrite off to a lender to review, you need to talk with them. But what about this 1.25 DSCR? Right? So today, this is where you're going to learn truly about underwriting. Where are you getting your assumptions from? Some of your assumptions. I'm not talking about the expenses, but there are certain assumptions that you need to know from your lender because the lender is underwriting a particular way. And we try to mimic the lender as much as possible. So I would like to introduce, hold on one second. I'm going to read a little bio from my lender. And I'm going to tell you how I met her. Her name is Natalie Dumont. And I met her during the hold on one second, everyone. John Stanford. Oh, let them in. Because they had to register. All right, so when we were closing, working on the Dayton deal, we were going to do an assumption. However, the assumption didn't work out. Okay, it didn't work out. And we went on ahead and shifted to permanent debt. So I met this young lady. Her name was Natalie Dumont. And I'm gonna tell you something. Once I got with Natalie, you talking about someone that smoothed this whole financing thing out for us. She 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 smoothed it out, got us through. I do believe, and she could correct me if I'm wrong. We closed in less than 45 days. Less than 45 days we closed. So I'm going to read just a little bio, a little bit about her. And I just want to say I'm excited. I'm excited to introduce a distinguished professional. If if someone comes on, see if I could catch who that person is. I'm gonna come from my screen for a minute. But she's the director, as a director of an agency multifamily loan production. All right, I do know Bernardo Charles. I do know him. Natalie has carved out a formidable niche in one of the country's largest GSE lending institutions with over. All right. So again, I'd like to welcome Miss Natalie Dumont to the Commercial Multifamily Masterminds. Miss Natalie, I read a little bit of your bio, but would you please fill in the gaps and tell us more about Natalie Dumont?
Sure. Hello, everyone. Good morning. Thank you very much for joining this webinar. And Daryl and Jim, good to see you guys, first of all. And thank you for inviting me. So my name is Natalie Dumont. I'm on the agency multifamily production team with Walker Dunlop. If you guys are not familiar with the company, we're one of the top and biggest GSE lenders on the market, licensed for any product you can imagine with Fannie, Freddie, small balance, conventional, which is large balance, all kinds of affordable credit facilities, lease up, workforce, housing preservation products. So basically any product that Fannie and Freddie offers, we are licensed to originate loans for. And I've been in commercial real estate, lending since roughly 2012. Before that, I was a residential lender. So for the last 12 years, I've been in commercial, and for the last 6 years, I've been in the agency world, which is super exciting. I know the products very well, and I'm always looking forward to meeting new people as well. So thank you, Daryl. I had the privilege of helping Daryl and Jim with one of their acquisitions, as Daryl mentioned. I think it was last year. And since then, Daryl and I have become good friends. At least that's what I want to believe.
Oh, that's right.
Thank you. And we've been working very closely together on a number of deals. So Daryl suggested that we put together this little session to go over underwriting assumptions from lenders' perspective, which I think is a great idea because I truly believe in sharing my expertise and showing you guys how we underwrite in order for you to be able to make similar assumptions when you do underwriting on your side before you bring the deal to me. And I want to hope that this session is going to help you. And again, remember that this is a very complex world of underwriting for agencies. Obviously, I don't expect you to remember everything I'm gonna say during this presentation. So I'm always here for you. You can always reach out to me. We can go over it together again. And I always say that the more deals we look at together, the more comfortable you will be with these assumptions in your underwriting. So I've been thinking how we should do it. Instead of just a formal presentation, I think it's much better if we do it as a live conversation. So I'm going to go over the financials that you guys send me usually in a package, and I'm going to point out what I'm looking at, what I'm looking for, what conclusions I draw from the numbers that I'm seeing, and how we obviously going to normalize expenses and everything. And I am going to go over one of the recent deals that I was looking at. Daryl, am I able to share?
Yeah, you should be able to screen share.
Okay, fantastic. So let me just find the document. Here we go. All right. Okay. So Daryl usually sends a perfect package to me. Perfect package for me is, first of all, his underwriting model. I am not looking into returns and all that as closely as you guys are, as potential investors, passive investors, or potential general partners. I am looking for information obviously relevant to me. So one of the tabs in his presentation usually is the deal summary, right? So what do I need to know? I need to know, of course, the address. I need to know when the property was built. I need to know what's the whisper price or what target offer price what offer price we're targeting. Very important for me also to have a budget. So what are you going to do with the property, right? So one of the documents submitted to me usually is operating memorandum. Not that it is 100% required, of course not, and especially if it's a off-market deal, we understand that there may not be one available, but OM usually gives us a very good big picture of what this deal is about, what type of property, and everything. So in this case, Daryl's deal summary is actually pretty good. So we have the purchase price here. I see that's what where he wanted to get to, or where he's getting to in his underwriting. So he's looking to hold the property for 5 years. So obviously that tells me that we have to price it for 5 years. Daryl is usually very conservative in his underwriting in terms of the rate that he's using, which is absolutely great. So I'm on the same page with him on that. So I would rather have surprises that are nice rather than the other way. So 7% is the rate he's using in his underwriting. That gives us a little bit of room, especially we're talking about probably a conventional deal. And the difference is that for small balance deals, small balance deals are those that are under $7.5 million for Freddie Mac and under $9 million for Fannie. So in this case, the loan of $8.6 million, technically, it can also be a conventional Fannie loan, but it is definitely a conventional Freddie Mac loan, right? So he is looking for 2-year interest only, amortization 30 years. So everything looks good. Next thing I look at is the rent roll. So why rent roll is the first document for me to look at is because I am trying to determine if we have a minimum occupancy on the property. So agencies require at least 90% occupancy over the last 90 days. And remember, guys, this 90 days is important as well. So basically, if the property has been at 80%, and it just got to 90%, remember that we still have to hit 90 days at 90% by the time we close. So technically, before we sign the loan, it's going to take a little bit of time, right? Because you're going to make an offer, and then if the offer is accepted, you're going through the due diligence. So it's quite a bit of time before we even sign the deal. So technically, if you got to 90% now, and we're a month away from signing the deal, and it's at least 2 months to go through the process, underwriting process, then we should hit that 90-day mark by the time we close. There is an exception though. If it's the property that is brand new and it's been going through the lease up and it just hit 90%, depending on the deal and how strong it looks and everything, we might be able to get a waiver for T1 instead of T3, meaning that we are going to underwrite based on this 1 month of 90% occupancy instead of 3 months. So rent roll. So what do I see on this rent roll? First of all, at a minimum, the rent roll has to have a unit mix, which is we have it here, square footage, that's important for us. So I often see square footage missing. We try to do our own research, CoStar and other sources that we use, but if it's provided, it's very helpful. Tenant names, obviously not really that important at this stage, but also nice to have, and I'll tell you why later. So market rents are important because if I don't have market rents and you have vacant units like this, my system is automatically going to average the rents for similar units. Okay, so not necessarily those numbers are going to be higher than the actual contract rents. So market rents, contract rents, move in, move out dates, that's important as well. For example, lease end dates here, as you can see, ended. So this lease is ended quite a while ago. That tells me that these tenants are probably month to month, but I will always reach out back to you to confirm. So of course, we do see these dates not being super accurate, at least when this rent roll makes it to me. But when this goes to underwriting, everything has to be accurate, absolutely everything, because I can tell you guys that everyone is looking at these dates very, very closely. And if there are discrepancies between, obviously between the actual dates and what we see on the rent roll, that's a problem. So in many different ways, it's a problem. So the rest of it, vacancy, charges, balance is not really that important to me right now. Sometimes rent roll has information like, for example, the delinquencies, 30, 60, 90 days delinquencies. This is also very helpful for us to see. And now, so let's look at it a little bit closer, okay? So we have a unit mix. Why do I need the unit mix? Because we run affordability tests on each property that we work on. And the purpose of that is to see if there's any percent of units rented at a certain AMI. In most cases, we're looking for from 50 to 80% of units being at or below 80% AMI. So that gives us certain affordability level. And as a result, you get discounts on rates, which is very important. With Fannie Mae, for example, you can get sometimes up to 60 basis points off the rates if your property is highly affordable. Freddie is, depending on the market, somewhere between 30 and 40 basis points, which is also quite significant. And depending on the market, if it's a top market, like Dallas, for example, is a top market, right? And it's also, in addition to that, a high cost burdened market, then in this case, we may be looking at 120% AMI, not even 80% AMI. Like if you're looking at New York, nobody expects rents being in 80% AMI, right? So it's a very expensive market. So Freddie allows us to underwrite mission discounts based on 100 or 120% AMI. So that's very helpful. Okay, so I'm looking at this rent roll.
So Natalie,
yeah.
Natalie, let me ask you a question, because some people may not know. What does AMI stand for?
Yes. So AMI is area median income.
There it is.
So, and it is very much market specific. So we pull the information, obviously that test that we run pulls the information for that sub-market, okay? All right, so what am I looking for in this rent roll? So I'm looking for vacant units, first of all. And I made this little summary here so we don't have to go through the whole thing. So there are 268 units. There are 24 units that are vacant. It's only 9%. We're above our minimum 90% occupancy, which is fantastic. Then I'm also looking at this code. Well, maybe not this code. Sometimes there's also a column that says what the status is. So if I, for example, see that a bunch of these people are under eviction, so I hope you guys are aware of it before you send the deal to me. But of course, this is a concern that what's going to happen while we're in process, right? Are these folks going to be evicted? We're very close to 10% vacancy. So we don't want that to happen during the loan process, right? Because proceeds will drop and we may not even be able to work with the transaction anymore if it drops to 80, vacancy drops to 85%, for example, or something like that. Okay, then, so vacancy is fine for this deal. Then I'm looking at the names of the tenants. For example, who is this, right? So if I see the name that sounds commercial to me, I need clarification. I need to understand who is that tenant. Is it being rented as an office to somebody? Or is it just a leasing company name? I do see that happen as well. They bring tenants and they just have their name here. But that's something that needs clarification as well. There's this unit interesting, is test. So I need to understand what that means as well. Okay, and obviously the number of units, if the OM is telling me that it's 268 unit property, the number of units has to match. And you'll be surprised how often I see the count of units not matching. So it depends on, obviously, the sellers don't always have very clean financials, but this is just something that is important for us to understand. So everyone else looks okay here. So we have market rents for these units, which means that my GPR in underwriting will include all these vacant units at market rates, okay? So let's see what else. Okay, so then obviously if there are subsidies, it's good to know. It would be nice to separate them from the contract rent, but I understand that sometimes you get the rental, in most cases, I should say, you get the rental that might include subsidies in the total contract rent, which is okay. But it's also helpful to know how many Section 8 people on the property, everything you know about this property, please share with me. So that's what I'm saying, because sometimes you guys might assume that this is not a problem, but for me, it's something that I, for example, have to bring up to agencies and discuss upfront, things like that. So rent roll seems to be fine for this deal. Then I move on to T12. So this T12 is through January, which was okay at the time Daryl sent me this deal, but obviously today we would like to see February offered added to it as well. So on this document, most important line for me here is the net collections, right? So total rental income is the net collections. So if you can see, their GPR is 214, and then we have some vacancies, we have some delinquencies. There are no concessions added here, so I'm assuming that they haven't been offering concessions. And this is how the trend looks for rental collections. Okay, so in the case of this property, it looks actually pretty nice. It's quite stable, a little bit up, a little bit down, which means that people move in, move out. That's fine. So for the delinquencies, first of all, remember that we underwrite the T3 income. So what basically it means to you is that we take this 3 months of rental collections, annualize them, and this is our rental collections that we have to underwrite for the agencies. Because again, unless it is a brand new property where we know that they just got to this 90% occupancy, then we will most likely underwrite to annualize this figure, annualized. Okay, it's actually a little bit lower. Well, it's kind of in line with T3, 554, and so the average is 184,857. Yes, so it's about the same. So we can underwrite T1. Why in this case Daryl, go ahead.
So Natalie, when they did this T12, they reversed it. So actually on the left side, you will see it going into 2024. I don't know why they did that. See, that's December 2023. So
that makes sense. I see that the income is growing. Well, thanks for bringing it up, but that makes it a little bit confusing. So yeah, see, so things like that, I definitely need to know upfront, because We have a very sophisticated, even though our system is very sophisticated, but it's going to read this last 3 months as the most recent 3 months. Okay, so, and obviously that's a different conclusion and a different different T3 we're looking at. But typically, again, this should start from 12 months ago, and this should be the most recent months. And that's how it is usually. So this is very rare that I see something like that. All right, so this is our rental income. And then we're looking at other income. So what constitutes other income? Where is your other income coming from? So this is something that you should also pay close attention to. Normally, I see a lot of different items here. So here it's quite simple. So we know that a lot of other income is coming from late charges. So you draw your conclusions. What are people late on, right? And then RUBS. So most of other income comes from RUBS, which is great. And interesting, by the way, Daryl, if this is yeah, actually that looks good. So we're going the other way. So see how RUBS are going up from month to month. So that tells me that probably there were a lot of vacancies here 12 months ago. Now, the more people occupy the property, the more they pay, they reimburse for water right here. So that's a good trend as well. Okay, overall, this net rental income is a very, very good trend. It looks like a strong performance and actually a very similar trend with the total other income. So that looks good. Okay, expenses. For the expenses, the most important categories for us are real estate taxes, insurance, R&M, payroll, and G&A. So these expenses have to be underwritten no matter what, with one small exception. So if you, and property management, I'm sorry, also property management. So agencies look at the deals from the perspective, what it's going to cost us to run this building if we end up owning it. Okay, so even though the property, you may be running the property very lean, you know, and you have much lower expenses than, for example, you share payroll with other properties that you own, you share G&A expenses and all that. It does happen, of course, but unfortunately, we still have to underwrite market expenses. And market expenses are usually determined by the appraisal. Okay, so at the time we size this deal in order to quote it for you, of course, we do not have the appraisal, but we are trying to do as much due diligence as we can. What it means is that we pull comps for the submarket. We try to use different sources to pull these comps. We have our own Walker Dunlop because we close a lot of transactions. Obviously, we can pull Fannie Mae comps, Freddie Mac comps. So we have to be within comps. So if this is an acquisition, and my understanding that most of the transactions that you guys are looking at here are acquisitions, then we can underwrite your budgeted expenses. But it doesn't mean that budgeted expenses can be so much lower than T12. Of course, we still look at T12 and we see what it costs them to run it, you know, but if your budgeted expenses make sense, and we also run them against comps and they are within the comps, we can drop the expenses a little bit. There are sometimes markets where it's hard to find comps. So what do we do in this case? We reach out to our appraisal group. So we own a big appraisal group, which is a huge advantage because, first of all, we check on taxes with them, right? And that's very important because ultimately we will have to go by the numbers that the appraiser sends to us. So we reach out to check on taxes. We can ask for comps. And obviously, if the appraiser is telling me we can support these numbers in this market, we are as close as we can be to underwriting the actual expenses, right? Very close to where we will be in process. So that's very helpful. Again, so we have here payroll on a T12, so it looks good. Salaries, contract services, we have administrative expenses here. We have utilities, everything looks good. So notice that there are utilities for vacant units, and that only confirms this RUBS line. Remember how it goes from very little RUBS to more RUBS because the more units got rented. So same with this line that clearly shows that these numbers, well, they're in line. So that basically tells me that there were few vacancies throughout the year, which is great. Water and sewer and gas, we have maintenance and repair. So these two lines is the combined R&M for me usually. So actually this is the, hold on a second, this two. So these two are my the R&M numbers, right? Make ready. So what usually goes to R&M? Make ready, paint and decorating, contract services, and repairs and maintenance, just routine expenses. So that's my R&M in underwriting, and I'll show it to you later. So here are the taxes and insurance. Again, it doesn't really matter how much the seller is paying now, because we know that most counties, in most counties, the sale triggers reassessment. And we're obviously familiar with a lot of markets, and we don't necessarily need to reach out to the appraiser every single time. Like, for example, if we're looking at Houston, right? I know that in Houston, the reassessment happens every year, and they go by the fair market value, because it's a non-disclosure state. The assessor will not know the purchase price, but they do a very thorough research. So say they come up with a fair market value that is, say, $1 million less than what you paid for this property, right? And then they take 100% of this fair market value and multiply it by the millage rate. Millage rates sometimes, depending on where we are during the year, we may not have the new rate, but this is where the appraiser is also helpful. They can tell us what the trend has been with millage rates. For example, I found out that lately the appraisers were discounting the millage rates in Houston because they expect them to come in to come in lower than the previous year. So you take pretty much your purchase price and multiply it by millage rate, and here is your new tax. Okay. So if this property has been owned by this seller for a while, then their taxes, chances are that their taxes are probably lower than we will end up being. Okay, and then we have, again, pest control, depending on the agency, goes either towards the R&M for Freddie, or it's a part of utility, I'm sorry, not the pest control, trash. Trash is the part of utilities for Fannie and part of R&M for Freddie. And all of this is also R&M, okay? And so here in this case, we have, Daryl, I think you had the, yes, so that's your expense ratio. So 45% expense ratio is okay. I can tell you that the smaller the market, the higher the expense ratio is usually. That's what we're seeing. In top markets, probably somewhere there, 45%. But again, we pay attention to that. So if we're significantly below what the comps show, that means probably that we have to bump expenses a little bit. So basically, guys, the idea is that we are trying to underwrite, pre-underwrite, I should say, at the quote level, with the idea to be as close as possible to where we think we will be in process. Of course, there is a lot of information that is not available to us. The third-party reports and the underwriters look at the actual financials, which seller might not be willing to share upfront with us. And they're certainly hurting you. They're certainly hurting themselves, because if I'm giving you the quote that is lower than you expect, you are not going to make an offer that they expect. So it's like a chain reaction. Okay. One more thing I wanted to mention is that let's see our rental. So our rental is from January 19th, and our T12 ends December. So at that time, at the time I got this deal, probably these were the most recent ones available, right? But it is very important for us to see the last month on T12 being the same as the date of the rental. Because again, remember those last 3 months with underwrite? Again, if there were a bunch of vacancies and the units got filled, so those numbers are not going to be reflected in the old T12. Guess what? If this is December and they rented a lot of units in January and February, and we're in March right now, this is a completely different picture. Completely different picture. Also, this is the rental from January. Today is March, and I'm being told that a lot of units got filled. Again, I need to see which ones of these units are now occupied, right? Because if their collections, for example, right here, these collections look good, and they are, say, 5% of today's GPR. What is GPR? GPR for me is I take all these units, current rents, plus this market rents for vacant units, and this is multiplied by 12 months. This is my GPR. Full rental is my GPR. And then when I say that we underwrite 3 months of collections, that means that I have to bring this number, which was here at the bottom, say roughly plus vacant units. This number I have to bring to an annualized 3 months. And if the difference between the two is less than 5%, for example, I still have to apply 5% because that's the minimum for any lender pretty much for vacancy. Okay. But if this number is, say, 10%, the difference is 10% between my GPR and the T3, but T3 we know ends in December, and we had a lot of units rented since then. Why am I applying 10% vacancy if it's really 5 maybe now? But there's no way for me to know unless I have an updated, most recent T12. So T12 is extremely, extremely telling to us. We draw a lot of conclusions from T12. Just remember that. And our goal, again, is to give you as much money as we can. And the last thing we want to happen is retrading. The last thing. I assure you guys, no lender wants to retrade you unless it happens that we see something during the process that we were not aware of in the beginning, or maybe something happened during underwriting to this property. Again, nobody expected that. These things, of course, affect the proceeds you're getting. But at least in my world, I will not give you a quote with overestimated proceeds. I rather underestimate a little bit and get you more during the process. Okay. So again, taxes, we just briefly touched on taxes. So see how here it wasn't exactly correct that it's 85% of the assessed value. In Houston, it's 100% of the assessed value. There's an estimated millage rate, which is probably coming from, look, so we did not have 2024 rates yet, and we still don't. Again, this is exactly what I said, that appraisers actually give some discount on the previous year, a millage rate, and that's what Daryl has here. But Daryl is using actual 2022 rate, which is higher. Again, being conservative, that's great. But remember that it's 100% in taxes. It's 100% of the fair market value that you should apply the millage rate to. Okay. So then, pro forma, what do I need here? So here I'm looking at year 1. So T12, obviously I have it. I looked at it very closely, but I want to know what Daryl's plan is in year 1. Okay, so he's projecting probably less vacancies, which is exactly what he should do. That's the goal. His RUBs are in line with what they're getting now. Again, that's being conservative. Fantastic. Obviously, there are more units that are rented. This number will go up. Other income, again, about at the same level. I understand. I agree to that. And expenses. So this is a nice comparison where Daryl thinks what it's going to cost him to run the property. See how, again, he's being conservative on most of the expenses, repairs and maintenance and everything. And so these are the expenses on his year one budget that I'm using for my budget and underwriting. Okay, so when this populates to my underwriting and I run it against comps, if something is significantly higher than comps, I will share with you guys, because maybe he just I'm not sure how all of you estimate expenses, where you're getting expenses from, comps from, and what you use for that. But again, I will tell you if this looks significantly above the numbers that we're seeing. And I also want to understand how you came up with that number, why you think it's going to cost more. Or if it's the other way around, obviously I have to bump that a little bit to comps. Okay. So this is the budget. Daryl also actually has usually a monthly breakdown, which is very nice as well. So I'm assuming that the total for this 12 months is what I'm seeing here in year one. If there's a difference, then that's something that Daryl and I usually discuss and come up with the budget that should be used for year one. And this is my lender underwriting. Basically, that's similar to how my screen looks. My document has this breakdown for monthly breakdown, but I usually like looking at the quarters here, T12, T6, T3, T1. Again, remember, T3 is important for me for income. And in the case of, acquisition, I'm looking at budget for expenses. But if it's a refinance transaction, then I am looking at the T12 expenses as well. Okay, so again, same trend. The rental income is increasing. What's happening here with the other income? So we see that RUBs are increasing, which is great. It confirms that the property has more units rented. Application fees, that's probably natural turnover. People move out, people move in, right? And this is my column here, by the way. Sorry, I should have brought your attention to that. So this column is my underwriting. Again, notice how interesting here. So, okay, that's what happened. So basically this number has to be the same as T3. Remember, that's what I was telling you about. But we were able to make adjustments because we basically annualized these numbers on a T12, and that's how we ended up with the slightly higher net rental income, which of course helps. And then, and I know we're running out of time, Daryl, so I'll make it quick. So, and then for the expenses, again, I make a note here that this is the purchase price multiplied by rate, and notice again how it is different from what, actually, Daryl probably didn't have that number here before, but this is how the taxes are changing compared to T12. This is the budgeted insurance, so that Daryl did his due diligence, got a bunch of quotes, and that he estimates that it's going to be $310. Utilities are always at T12, I'm sorry, trended 3%, because we need to see historical, unless again, it's a brand new property, and T1 reflects the actual utilities for occupied, stabilized property. And then pretty much everything is at budget. So I have R&M at budget, I have payroll at budget. See, here is where I had to bump the G&A, because in this market it was expensive per comps at $520 per unit. So this is my bump here. we have, well, this was, I get professional fees, interesting. Yes, so this number was below 520, that's why I bumped it. And this is basically this is total expenses with taxes and insurance, and this is net cash flow. So I know we're running out of time, but I hope you guys, it was helpful for you. Again, reach out to me if you need help. I'm happy to look at all the transactions that you send. I'm happy to talk through them. I'm happy to remind you how we're going to look at it. And again, if there are any issues with the properties, you think it's an issue, don't think it doesn't fit agency. Reach out to me. We will look at it together. We will run it by agencies. We will make sure that it will work.
All right. All right. So, Renee, I know it's 12 o'clock, but can you give us maybe 2 minutes, 3 minutes?
Yeah, me, yes, for sure.
Okay, great, great, great. So I was taking notes, and what I wanted to do was I would like to relate a lot of this underwriting with so that the new investors would understand a lot of things. And you touched on a lot of stuff that I want to bring up. One, you mentioned about and I'm looking at I'm trying to get a picture in my mind of my model. So you mentioned about the vacancy rate, about not going. I do believe you said 5%. Now, depending on the market, will you look at what the market vacancy rate is to see what the minimum is? You know, because the one thing I think a lot of us are taught is never go below 5, but make sure you check to see what the market vacancy rate is. Because if the market vacancy rate is higher than 5, you need to underwrite your market vacancy at what it is, whether it's 10%, 6%, or 7%. Do you also look at that, the market vacancy rate?
So if we have a property that has been stabilized for a while and we see that it's running at a low vacancy, and T3 collections again are within 5%, we will apply 5% if it's supported by the historicals. Where vacancy rate is important is if it's a conventional deal, for example, Freddie Mac will look at it and they will say, you know what, this is a very small market, vacancies are usually high. They probably will pull back on sizing parameters a little bit. So that does happen. And this is, by the way, the major difference between conventional and SBL programs, because for SBL, which is small balance loans, the program is very streamlined, right? So they already have all markets categorized into top, standard, small, and very small. And that's where the pricing is different, discounts are different, the affordability requirements are different, and all that. That's already accounted for. But in a case of conventional deal, yes, sometimes maybe they don't even want to be in that market. It never happened to me, to be honest with you. Right. But I know that there are certain markets that they may not like at all. So we definitely look at the market data, but historical performance is important.
Perfect, great. So I would like to just touch on DSCR and the loan to value. Mm-hmm. So in today's market, I know a lot of the loan to values, I've seen 60%, I've seen 65%, right? However, if you're looking at a particular underwrite, I send you an underwrite, my year one DSCR is coming in at a 1.45. Could that bring my loan to value up from a 65 maybe to a 70 or 75%?
That's a very good question. So in the example you gave, we could only see 145 that cover if we were already at a maximum LTV. For example, you have such a strong cash flow, say your property is $10 million. $8 million is the maximum I can give you in this market. And I'm automatically sizing to max proceeds. Okay, so max. When the system is asking me what's the maximum LTV we can go to, I say 80%. So and I see that the loan of $8 million is at 145 debt cover. So in this case, obviously we cannot go above 80% per the program, but you will be getting extra discounts for being at such a strong debt cover. So normally we are constrained by debt coverage. Okay, so there are two things that can constrain us: LTV and debt cover. So we usually size based on the minimum debt cover, wherever that LTV is, based on the minimum debt cover. Does that answer your question?
Yeah. You also mentioned about the Section 8 income. So you look at the rent roll, Section 8 subsidy, and then rent, right? So the rent's going to be a little lower because Section 8 is going to pick up the rest. When you're looking at that, do you combine those two numbers together?
Absolutely, absolutely. That's the whole point. Yeah, I also wanted to mention that Section 8 tenants do not make the property affordable, meaning that you still qualify to go through the core small balance, whatever conventional program. If there is a HEP contract on the property, any sort of regulatory agreement, that's what makes the property affordable, and that's in this case we have to go through the affordable program. Otherwise, Section 8 folks, the vouchers are attached to tenants. The units are still market rate units. People can leave anytime. So yes, we combine their rent, and obviously it has to be within the limits per the HPD.
Got you. Okay, great. So, because that's really important. A lot of times, I believe some underwriters will take that Section 8 income and not include it with that, and which will, of course, we all know what happens when you do that. That brings that down. All right. So, go ahead.
Yeah. No, absolutely. That income is included. And we like it that property has Section 8 tenants. So that tells us that in most cases, in most markets, that makes the property much more affordable. With the exception of markets like New York, for example, sometimes Section 8 rents are above market. So that's when the underwriters might bring that number down to market rents, discounted a little bit. So, but again, not necessarily, but I've seen that happen.
You had also mentioned about a trend, and I do believe it was on the growth. It was like a 3% trend, you said, that you look at?
For the expenses?
Yeah. Let me see, because I think it was on here. 3%, right there. Yes, right there. So
yes,
is that 3% based on markets? So that if I'm underwriting and not, you know me, I love Houston, I love Dallas, I love the surrounding and the submarkets of Texas, that is, of Houston and Dallas. So now since I see a 3% trend, should we as underwriters adjust our trend to 3%, or depending on the market that our property is in, should we try to find out what that trend is and adjust no?
Daryl, you're complicating things.
Oh.
No. So basically 3%, we're assuming that these expenses will probably, because of the inflation, they will go up by 3% next year. It's not market specific, but you bring up a very, very good point. Unfortunately, I'm not showing the actual model that I'm using, but in the actual model, we also have an exit strategy tab where we put in income growth, projected income growth, and expense growth rates. So these are the rates that we pull from Fannie, and Freddie applies their own rates. So those rates are completely different. But for year one underwriting like this one, we are just trending expensive. If it's a refinance transaction, 3%. The reason it's here on the acquisition is because for utilities we only underwrite historicals. So even though you're projecting here 355, that number I ignore. Okay, so
Right.
these are the numbers I'm using in a T12, and they're trended 3%. Everything else is at budget, remember? So I have everything in budget.
Got you. There was one more, I think, let me see. There was one more thing I wanted to see if you would just explain to me a little more. And that was in reference to this, can you go to performer, hit the performer tab?
Yeah, 1 second. Let me just do this, please.
Yeah,
Okay.
right there. If you'll click on that for me. I want to ask you a question. There's something that I do. So right here and I'm glad you're right there at the growth potential, the gross operating income. If you notice on the T12, it says, let's round it to 2.4 million.
Yep.
Oh no, back to the performer for me though, on the performer. Right.
Mm-hmm.
So what I normally do is on my year one, I adjust my loss to lease to make that equal to my T12. Now, the reason why I do that is because I know that on the day that I close, that income coming in is what I'm gonna have to work with for that first, I'm gonna say 6 months, close to a year, right? And that's the reason why I adjust my year one gross operating income to match that of the T12.
Mm-hmm.
Now, and when you look at that, do you say, okay, well, let me ask this question. How do you look at that when you see that when I've adjusted that to make it equal to, instead of having a 2.5 million, knowing that on day one, I'm not going to have that kind of money?
So a very good question. And the answer is, I don't really care much about it.
Gotcha.
Because remember, Daryl, my numbers have to be at T3 with that small exception of T1, right? So
Right.
I do pay attention to it because I'm curious. So what you're thinking, what thinking is going to happen. But of course, we understand that you're taking it over with the numbers per the probably T1, not T12, right? So yes, I still have to underwrite T3 regardless of what you're projecting, because again, like you said, first 6 months you think you're going to be at the same income, then people will start rolling and the income will increase. So since we only underwrite based on in-place income, I unfortunately have to ignore these numbers. This is just for me to know that you have a solid plan and this is how you're going to reach it. Okay.
Gotcha. And I'm going to just one last question. I'll let Mike ask question. I'm gonna let you go because we really did go over, and I don't want to do that. So a lot of times when I send you my underwrite, the one thing a lot of times I don't do a T3, and it's just a habit that I was taught, right? That I don't do a T3. So when you do a T3, because now I'm gonna start doing T3s, right? So now I do believe you mentioned this one time before. When you do the T3, you look at the gross potential rent, you T3 that. Is there anything else that I need to start T3ing, such as the vacancy, bad debt, concession? Should I T3 that? And I do believe you said don't T3 the expenses. Am I correct?
That's correct. So yes, T3 income for us, T12 expenses or budget if it's an acquisition. So Daryl, it is really up to you. I don't need you to send me the T3 because again, I have this sophisticated system that does that for me. See how I have everything here in my analysis. So don't do it. And in addition, don't waste your time because maybe we will end up going by T1. Depending on if we have a supporting story, again, it has to be supported. Why we are choosing T1 or T3. 99% of the cases will be T3, but my system will do it. Don't worry about it. Only if you want to better understand where I will come in most likely, then you should look at the T3 income for sure. It will just help you understand where I will probably what I will come back with. Yeah.
Okay, great. And Mike, I'm gonna let you close us out. Take it.
So when you look at it from a T3 perspective for the loan to value that you can get on the asset, wouldn't the
Mike, you're breaking up.
income technically be higher for the last 3 months than? Hello?
Yeah, you break it up real bad.
Mike,
yeah.
would you mind repeating again?
Yes. On a T3,
Mhm.
comparing it to a T12, if you underwrite to a T12, technically you'll probably get less income because maybe the property was more vacant in some of those months. And in the-
Absolutely. Absolutely. So we're giving you the benefit of having more income in the last 3 months. Yes.
So therefore, technically, if you look at it from a T3 perspective, you can, in theory, maybe pay a bit more for the asset.
Yes. Yes. And this is
Okay.
why we sometimes decide to go by T1 again, like I said, because if you had even more units rented in the last, not if it's just a natural turnover, you know, if people just left and you couldn't rent the units, that's clearly T3. But if the property has been going through the lease up, then we can give you the benefit of being a T1 income.
Gotcha.
Okay.
Okay.
And in this example that you have here that Daryl shared, did you manually enter the numbers into Excel? Because I think you said that you guys have a different system, correct?
No. This is definitely coming from my system. It's all automated. I just
Okay.
copied it from my model here. That's why you don't see any formulas or anything.
Okay.
Yeah.
Thanks.
All right. Thank you. Now, Natalie, I want to say thank you very much for coming to the Commercial Multifamily Masterminds. I'm going to have to bring you back because
Yep.
you know
Happy to come back.
our time got eaten up by a lot of unnecessary noise. But I want to say thank you very much for coming to the Commercial Multifamily Masterminds, helping us to understand underwriting a little better. And for everyone out there, you know, Natalie, can you please put your contact information in the chat so that
Yes.
if
Let
they
me
need
see.
if they need to get in contact with you, they can, because you know this was fantastic. This was fantastic,
Oops.
and this was something that we definitely needed. We needed to hear the lender's perspective. That's what we needed to hear.
Yeah, just remember, guys, we're here to help you, you know, not to take away from you. And if you start seeing it as, hey, this lender can help us understand where we're going to be with this purchase, isn't that the goal?
That's right.
So we'll work together. I want it to be a two-way communication. I don't want to just give you the quote, you know. It's easy for me to put together a quote and send it to you. I want you to understand how I came up with these numbers. Let's brainstorm together. Can we improve something? You know, is something not looking right? Maybe utilities are higher because there was a leak on the property. All that matters. And we will only know if we actually discuss that and talk that. And that's what I usually do. So I size it. Before I send you the quote, I bring you on Zoom with me. We'll look at everything together to make sure that it makes sense to everyone how we came up with these numbers.
All right.
That's you. Usually it's very educational to you guys as well. You know, next time you will know how we will probably approach it.
Yeah. And I can vouch, she's definitely an educator, because she educated me a lot on the Dayton deal. She really did. Made me understand the movement, how, you know, the process and everything. So Natalie, I want to thank you for coming to the Commercial Multifamily Mastermind. I'm going to have you back. I got to have you back. I'm gonna give you some time, but I got to bring you back so that we can.
Sounds good. Look forward to it, Daryl. Thank you so much, my friend.
All right, everyone. Listen, don't forget tomorrow. Okay, tomorrow, Wednesday, 2 p.m. Eastern time, capital raise strategy session. All right, do not forget. We want to see you there. Capital raise strategy session, and I will see everyone back here on April 2nd. We'll have another guest speaker, more underwriting, so that you can understand how to underwrite. Okay. Thank you all. Have a blessed day.
Thank you, guys. Have a great day.
I'll be in communication with you. I'm going to see some properties while I'm out here in Houston.
Awesome.
All right.
Thank you. Bye.
Thank you. Okay.